you're watching Stock Watch. I'm Zinati Puma, and joining me to unpack your stock-related questions today are Jean Pierre Verster from Protea Capital Management and Nader from Benguela Global Fund Managers. Be sure to send your questions through via email to stockwatch@pdtv.co.za, via SMS on 41392 or an X at Business Day TV using the hashtag StockWatch. Thank you so much for your time, gents. Let us get straight to the questions because I'm sure that there are more questions that will be coming through as the show is live. Okay, let's start off with, of course, lots of company results trickling through. And we did have on Monday Boxer coming out with numbers. So, JP, I want to start off with you. Is Boxer a buy at these low levels of 63 Rand? Of course, we did see some pressure on the share. Yeah, Monday was yesterday. Why does it seem like it was 3 days ago? But
It feels like it was 3 days ago.
It does, yeah. It's been a long 2 days. But Boxer at these levels?
Look, I still like it. There's a lot of complications, whether it's the number of shares outstanding and they do weighted average, or it's lease accounting as they aggressively open stores. There's the 53rd week. So one needs to make a few adjustments.
Yeah.
But I would say if you cut to the chase and you look at the net profit in Rand terms, and what it might be in the coming year, call it roughly 1.5 billion. And you look at the market cap, call it 60 billion. That means it's trading at a roughly 20 PE. So if you cut out some of the complication and you simplify it a little bit, maybe hopefully not oversimplify, then I think a 20 PE for such a strong growing business is decent. It's decent value. It's not a dripping roast. It's not amazingly attractive, but it's also not as expensive as people might think, because the earnings per share might go backwards next year relative to this year because of these weird accounting things. So I still like it. I think it's one of the few retailers that are aggressively rolling out space. They are still seeing inflation. Yes, inflation is going to moderate, but over time we would expect that they would see inflation. So I still like the business and I prefer it to Pick and Pay. So yes, I'm still a holder of Boxer shares.
I mean, it's interesting that you talk about all these complications, because I would have thought that investors would have actually shrugged off the accounting complications and that impacted their bottom line. But I mean, I still see that even today the share is under pressure. Grant, how would you be looking at this?
Yeah, I mean, I agree with JP. I think this is a high quality business. At the heart, there's a good business, there's good management, there's a clear growth runway. So there's a clear plan as to how they're going to grow, and you can probably rely on that growth because it's an easy path. You know, you roll out stores and you grow your business. They've got a good business model. They're underrepresented in large parts of the country outside of KwaZulu-Natal. 20 PE. It's on the upper end, but remember, it's a staple. It's defensive growth. And so ShopRite's trading more expensive than that, or at least in and around that level. So I think it's a solid one. It's not going to shoot the lights up, but it's going to be a steady compounder, and I like it. I would also be looking to buy some on this pullback.
Yeah. There's a question here. How do you see the retailers, in particular Woolies, faring in the next year? I don't know if you want to group them all in one group, JP, or if you want to look at clothing retailers. But yeah, your take on, I guess, just the general retail space in the next year.
So all of them went up a lot from the last election, which is now a year ago, into late last year. And then as the euphoria subsided, they all came down quite significantly to as recently as a month ago. And then most of them have bounced. Woolies, more or less the same dynamic, not to quite the same extent, because they do have some internal issues. Australia is slowing down more than what people would have expected. The upper end in South Africa is under pressure. If you think about, tax bracket creep and all the things that are pinching the upper income, upper to middle income part of the country. So Woolies, it has a few things it needs to fix, and people have been disappointed. They thought it would have been fixed, and they would have done better on Australia in the last year at least, and it hasn't really happened. So the jury is out a bit, but I do see value in Woolies shares. Again, for me, if you think longer term, they really have got a dominant position if you think about quality merchandise, whether it is food or it is, let's call it these days, your basic clothing. I wouldn't say that they are necessarily at the forefront of fashion these days, but at least if you want high quality basics, you would probably go to Woolies. So
Yeah.
given, I would say their moat has shrunk a little bit over the last 2 to 3 years, but they still have a moat. I still like the business. The shares are fair at this value, at this level, I would say. And if they can fix some of these things which are on their to-do list, then the shares could do well. So I would stick with Woolies for at least another year if I've got the shares, and hopefully the business can fix some of the small things they need to sort out.
But are they not taking too long, Grant? Because
Mm.
for the last few reporting cycles, it's literally copy and paste, copy and paste. Is it not? Yeah. Is it
Yeah.
for an investor who would like to see returns now, or yeah, what kind of investor would be going for Woolies at this point?
So, so it's a tough one. I mean, I have also felt that they've got such a good brand, and the food business is still a phenomenal business, best in the game margins. I don't think that's under threat, even despite what Shoprite may say. But I have concerns around the rest of the business. I think Australia is underperforming that environment. So that environment's tough, but they're even performing poorly, Country Road, if I look at it relative to peers. So I'm really concerned about what they're doing there. As you say, it's been a show me the same story over and over. When is the turnaround coming? FBH in South Africa looked like it was starting to turn the corner, but they've taken some steps back there again as well. The strategy seems to be a little bit unclear at the moment. They start to look a little bit like a department store with various different brands in the store. That doesn't work. We've seen that in the past. A lot of those stores have come and gone. So
Yeah.
I have some concerns around the strategy and execution. It's been enough time now that there should be better results. So I must say I'm starting to move to the fences on this one, and I'm becoming cold very quickly unless we start to see some rapid improvement.
Yeah. I mean, just in retail, I remember it was during COVID, there was all of a sudden this rush of these buy now, pay later companies listing. And so there's a question on that. What do you think of those business models? And particularly on this one called Affirm Holdings, listed in the US. JP, is this an area of the retail space that you look at?
It's an interesting space, buy now, pay later. I would firstly say we've got an interesting local option as well. Home Choice have effectively built a very nice buy now, pay later business in their belly. And yes, internationally, it's a firm. There's a big one, Klarna, that would have listed, and they pulled the listing a few weeks ago. There's a few other smaller ones. A firm, I haven't looked at them in detail, but from what I could see, I didn't like the bad debt metrics. So I think there could potentially be better buy now, pay later operators in this space. But it is an interesting space because it is businesses that have got an element of retail, but a significant element of short-term lending. And quite a lot depends on what type of products are they financing and how are they getting the money back. And through that, I mean, those are two key variables for any unsecured lender. It is your scoring on the lending side before you let go of the money, and then your collections in terms of how do you get back the money. And I think there could be one or two players that are better than a firm. So I'm on the sidelines when it comes to a firm, and locally Home Choice does look interesting.
You're actually right. I do forget about Home Choice, that they have that whole fintech direction now, and it's doing very, very well. Is this a space that is on your radar on any level, Grant?
No, not especially. I mean, I don't like this credit finance space particularly. And look, they're well positioned to use AI and analytics to lend more intelligently than perhaps people used to in the past. But
Yeah.
I don't know if they're good businesses, and I've yet to see them go through a down cycle or recession and to see how they absorb those losses and how they manage those books. So no, nothing that I would chase. But there's high demand. I mean, if you think of Home Choice, think of Lewis credit book. Massive demand. They're making a lot of money out of it, but their bad debt ratio is very high. I mean, so you've got to have appetite for that kind of business. I don't. Yeah, I would stay out of those, but that's also probably a lack of I haven't taken a deep look at
Yeah.
at these businesses.
Yeah. All right. Well, gents, let's get into banking. Grant, let me stick with you. I want to ask you about Capitec, and then JP, I'm going to come to you with FirstRand. I don't want to make you sound like a broken record on Capitec, JP. Grant, do you think Capitec can continue to outperform its peers? Is it a buy at current levels of 3,500? It was just under 3,500. I actually had someone doing technical analysis on Capitec earlier, and he said that he could actually see more upside, maybe going to that 4,000 level. Grant, your take?
It's a stock I do love as well. It has been my pick on the show. I think this year when it was down ridiculously at I think like 2.6 or somewhere around there. But I think it's a fantastic business. They're actually accelerating growth in some areas. They're accelerating the return on equity. They're doing an amazing job. I think they will continue to grow. Is it a good time to buy it short term? I can't say because it's run so hard. It might go on a bit further, but then that's like a trading view. But if I'm taking a 5-year view, I think you can buy it here and close your eyes. I think any South African investor should have it in their portfolio. It's one of the highest quality businesses with one of the few pure growth trajectories and a clear path to further growth. So I'm a big fan. I would buy it. As for trading shorter term, I'd maybe look at the technicals again myself before I make a comment on that.
All right. Let's get to FirstRand. Please provide an analysis on FirstRand, including buying levels, JP.
Yeah, so FirstRand used to be the preeminent universal banking group in South Africa, and they've lost a little bit of their shine. A significant part of that has to do with their forays into the UK and spending significant capital, and then unfortunately finding out that there were some sins of the past, which is now theirs to sort out, and potentially some large liabilities that they need to stand in for when Motor Nova made loans for vehicle financing. As a matter of fact, a few weeks ago, I think the Capitec market cap pipped the FirstRand market cap for a day or two. So that shows how FirstRand has lost its, I would call it, management premium. But still, they have structurally got a higher ROE than at least Standard Bank, Nedbank, or Absa has. So I would still say it is in my top 3 of the banks. And it's not too expensive. It's not too cheap either. So I would say it's a well-managed bank with a structurally attractive ROE, trading at a fair multiple, which already has the problems in the UK discounted in the current share price. And if there's a positive resolution to that, I mean, the government will sort of like trying to turn back the clock on what the courts have said.
Yeah.
And there is no huge liability that's payable in the UK, then you can see maybe some of the clouds lifting on the FirstRand valuation. So I like it reasonably.
Okay. Well, still with banking, is Investec a decent long-term buy? It seems it is the only bank not negatively impacted by Capitec. A good point, Grant?
Yeah, I mean, that is a good point. I think Investec is, in the last few years, they've made good inroads in streamlining the business, shedding some of these heavy, capex heavy parts of the business like private equity, etc. So I like what they've done globally. I like what they're doing in the UK. That Rathbone, I think it's the Wealth Partnership. I might have the name wrong of the partner, but the Rupert's or whatever, the Rothschild, sorry. But I like what they're doing. I think I'd like to have seen a bit more traction. They were doing really well, growing their ROE nicely, and then they've hit a bit of a wall. But I think they will. I think you will see them build on that again. Got some rand hedge qualities. I like it. I think it's a good business. I think it's still reasonably well priced. I think you can buy it. It wouldn't be my top. It's not in my top 3 banks, but I think you can own it as well.
Well, JP, we already know 2 of your top 3 banks, FirstRand and Capitec. Does Investec fall in there or outside?
No, currently at this valuation, I would say Standard Bank is the 3rd one in my top 3 bank bucket. So Investec, as Grant has said, Rathbones in the UK seems to be struggling a little bit, and the bank's doing okay. But every now and then, if you lend money to high net worth individuals, and sometimes it's significant lending, things go wrong. So I don't like private banking as much as I do retail banking, even as much as business banking. And when it comes to private banking, I prefer the wealth management side. And Investec have sort of diluted that with the Rathbones deal. So again, it's not in my top 3 of banks. But I wouldn't, if I saw it in a portfolio, Zanati, I would not sell it.
Okay, all right, got you there. Right, let's go into tech. Can you give your thoughts on Prosus for a buy? The report that they came out with last week was good. Can we expect more of this going forward? Well, the new CEO certainly thinks so, Grant.
Close your eyes and buy it. No, I remain bullish and constructive on Prosus, primarily because of Tencent, but you have got the added impetus of this massive discount. I think it's still 35% discount to Tencent on a look-through basis. And then all this other stuff they're doing on the delivery. They've got a good new CEO that's got a lot of experience in that online delivery space, coming from Brazil. And I think he knows what he's doing there. They seem to be a lot more focused on streamlining the rest of the business and the acquisitions they're making. So I think there's a potential optionality outside of the reason to own it in the first place, which alone would be Tencent. So I think it's a good business, absolutely belongs in every South African's portfolio in decent size.
All right. Your take on Prosus right now, with the strategy kind of sharpening and exceeding their targets. JP, would you be going for Prosus?
Yes, I would still hold it. The shares have done quite well the last few weeks as the negativity towards China has also lifted a bit. So, I liked it a bit more a few weeks ago when the shares were significantly lower, but I still like it. Also, mostly because of Tencent. I mean, that's one of the best businesses in the world. And the other things they do, it's not really moving the dial, but at least they've gone from detracting value to at least not detracting value and hopefully very soon adding value with the other things they are doing. So yes, I would also back Fabrizio and his letters that he releases every now and then so we can stay abreast of what is happening in the rest of the portfolio. I like it. Better communication that maybe was the case in the past. So it's a stronghold for me, Zanati.
I remember earlier on, JP, you said that you would choose Boxer over Pick n Pay. Well, Grant, this question is for you. It's on Pick n Pay at these levels. Surely Pick n Pay is a buy.
I still don't want to own it, and I haven't wanted to own it for a number of years. And I just don't see the strategy clearly. I don't see the evidence that it's playing out. I think it's a long road to recovery. There might be an opportunity there, but you need to have some confidence to see that that turnaround starting to gain traction. I'm not seeing it. I'm seeing them closing stores. I'm seeing them closing their online delivery parts of it, which tells you that they're losing the battle to Checkers 60/60. So I think they've got a lot of battles to fight at one time. Yes, they've got more capital, but there's a long road there, and I don't think it's worth the risk. I don't see. It's not obvious to me that they're going to get it right and that there's a great opportunity. So I would prefer to. I would leave it alone.
All right. Commodities. JP, I know you're also not a huge fan of commodities, but here goes. I'm giving you Sasol, and Grant, I'm going to give you PGMs. Bought Sasol at 130 Rand per share. What should I do now? Sell or hold? And actually, specifically for you, JP, have you closed your short of Sasol? What is the view for Sasol after Trump's new trade agreements? We did see it up yesterday, I think by 6 to 7%, can't remember, but I don't know if it sustained its gains. JP?
So normally I wouldn't disclose short positions on TV. It's normally a career limiting move. What I would say is the Sasol short we've had for quite a while is quite small now. So when you are a hedge fund manager and you short shares, risk management is very important. And your biggest risk when you short a share is that it goes up a lot. And when you are wrong and a short goes up a lot, it becomes a bigger part of your portfolio. It becomes a bigger problem, which is the opposite of when you buy a share and you are wrong and it goes down. It becomes a smaller part of your portfolio. So being wrong when you short shares, when you're a hedge fund manager, can be very costly. So hedge fund managers typically do two things when they have a book of short positions. Some hedge fund managers, as the shorts go down and they are right, they add to the short. Other hedge fund managers, when the short goes down, they don't add a lot to the short. I'm in the latter camp. So what that means is, if I'm right on a short, as has been the case with Sasol, it becomes a smaller and smaller part of my portfolio. So that if it happens that it jumps 10, 20, 30% even, I'm still in the money. I've still made money from where I shorted it initially. I don't like to increase the size of the short as the share price keeps on going down. So yes, still a short, but it's a very small short at the moment.
Okay, still sticking with you. Bought at 130 Rand, it's now at 67 Rand. What should you do?
Well, you can probably hold on at this level. Your money has halved. I would not double down. I would only double down on high quality companies. And Sasol does not qualify. Oil is still relatively low. The world is still not a good place for heavy polluters like Sasol. The gas is still running out. The coal quality is still going backwards. Plastics are still under threat in the US with more capacity coming on stream. Some of the gas might be exported rather than being imputed into these facilities in Louisiana, which might impact some of the spreads. So no, I would not buy Sasol, whether it is to cover my short or it is to double down because I bought at high level.
All right. Grant, PGMs. Let us know on the platinum price. Please let us know on the platinum price when it dropped from $1,000 yesterday and then picked up again today. But Implats has recovered from yesterday after a sharp drop. Yeah, can you pinpoint what is happening here at this point, Grant?
So the PGMs are a difficult sector to get our head around. And you know that people have been negative for some time because electric vehicles are eventually, we know they're taking a greater and greater share of the market, and they don't use catalytic converters. But what has happened more recently is the hybrid electrics have actually been, there's almost a transition. It's people are buying more hybrid electrics and they're slower to adopt the EVs than what was originally forecast.
Yeah.
So and they use PGM loadings for their emissions control. So the outlook for demand in PGMs has improved relative to, I'd say, a year or two ago. People were uber bearish on that, and they're less bearish now. And couple that with the cost curves of these miners, you start getting down to around the $900 level, and you're starting to bump against a lot of cost curves. And so I think there's been a natural support level there. At the margin, the outlook for demand is slightly better. And so I think, you see the PGM basket is up, I think it's about 10% this year. So there's a bit of demand. The profile's a bit better. I can see guys have been buying these PGMs. I can't give you a fundamental view on them. I mean, they might be good for a trade here. It looks interesting from a speculative buy, but I would not say I'm going to buy it with a 5-year view, because I don't think anybody knows what's going to happen in 5 years' time in this space.
Yeah.
You take recycling into account and things like that as well, it complicates it even further. So it's an interesting one. I think you could probably nibble here. I would look at the technicals if I was playing in this space more than the fundamentals, because those fundamentals are hard to analyze.
Well, things that aren't so complicated, your stock picks for today, JP, what are you choosing?
Mine is quite complicated, Zanati. So I'm picking a stock listed in the US. It's a semiconductor equipment manufacturer, Lam Research. LRCX is the share code, and they make all kinds of very complicated machines that are involved in the process of making computer chips. So everything to increase the yield of the wafers. And the wafers is that piece of silicon, looks like a pizza. Then they go to a microscopic level and they create these microchips. And Lam Research has got a bunch of different machines involved at different points of these very, very complicated processes. We saw a decrease in the tensions between China and the US in terms of tariffs. That's good for semiconductor manufacturing and the equipment makers. And there are further movements where the US might loosen some of the export restrictions. And I think all of this is very good for semiconductor equipment manufacturers like Lam Research. And I do believe that with the shares having been under pressure the last few months, the longer term trend is we're going to have more electronics that's going to need more microchips. They're going to become smaller and more powerful. That needs more intricate machines to create them. and that's good news for Lam Research.
All right. Grant, where are you seeing opportunity today?
So my opportunity is Uber. I have called it before on the show. It was in the
You're
around
calling an Uber?
$70 or 65. Yeah, exactly. I'm calling an Uber. I want an Uber to take me to my portfolio. No, so I still think there's a great opportunity there, and it's one of the cheapest large platform tech companies out there. And I think the opportunity has come because people are concerned about Waymo, which is the ride sharing, the robo taxi thing of Google and their partners. But I think, having looked at it, I think it's more likely they do a partnership than they become a competitive threat. And even there's a likelihood of a Tesla partnership. It's still early days, but that uncertainty is, I think, what's created the opportunity. And if those fears play out less badly than some people have expected, I think there's a massive opportunity for growth. It really is a large and growing platform, strong cash flows, margins are opening up, and the potential for further growth is significant. So I like it. I continue to like it. And that's my call, Uber.
All right, well, let me call an Uber and get out of here. Thank you so much for your time and for your analysis today, James. Really appreciate it. That is all for tonight's Stock Watch. Thanks to our guests, Jean Pierre Verster from Protea Capital Management and Grant Nader from Benguela Global Fund Managers. Up next, The Close. Stay watching.